Right now, the market is at a breaking point. It really feels like we're standing on a cliff edge. After months and months of just relentless hype, the AI sector is finally cracking. Investor sentiment has absolutely cratered into extreme fear, and for the first time in what feels like forever, central banks are openly sounding the alarm.
Now, let's be clear, this is not your typical boring central bank jargon. A direct warning like this, from the Bank of England no less, is incredibly rare. They are literally pointing a finger at the AI sector and drawing a straight line to the dot-com bubble. That, my friends, is a 5-alarm fire bell ringing loud and clear.
And bam, here it is in black and white. This number just perfectly captures the mood. The fear and greed index has plunged deep into extreme fear. So this brings us to the most critical question of all. Is this the beginning of that massive crash we've been warned about? Or is this extreme pessimism the exact buying opportunity that smart investors have been patiently waiting for? Let's dig into the facts.
Okay, so to figure out what's coming next, we've got to look back. What exactly went down last week to get us to this point? Let's dissect the numbers, because believe me, they tell a fascinating story about where the money is moving.
Just look at this chart. The divergence here tells you almost everything you need to know. The tech-heavy Nasdaq 100 was the massive loser, down more than 3%. Meanwhile, the broader S&P 500 and the German DAX got off way easier. This wasn't an everything-must-go sale. No, this was a targeted hit on tech.
So what lit the fuse? Well, it wasn't just one thing. It was a perfect storm of factors. We saw huge profit-taking in those few mega-cap tech stocks, you know the ones, that have basically carried the entire market all year. Then you throw in the uncertainty from the US government shutdown and some really weak consumer data, and that was enough to rattle everyone. But the real story, the big one, was that investors finally started asking, hey, are these insane AI valuations for real?
But here's the thing. This wasn't a blind panic. Far from it. The market got picky, really picky, and the EV sector is just a brilliant example of this. Tesla got hammered for weak sales figures. At the same time, Lucid Group stock shot up almost 6%. Why? Record sales. The market is actually differentiating between winners and losers again.
And it's not just in the tech world. Look at Pfizer. The stock got a nice little bump because it won a bidding war for a promising obesity drug specialist. This is so important because it shows that real-world business decisions, M&A deals, solid fundamentals, they're starting to matter more than just pure hype. Fundamentals are back in fashion, folks.
All right, so we've seen the market is getting a lot more selective. Now let's put on our detective hats and dig into the broader data, because the key indicators are sending some seriously mixed signals right now.
Okay, we've seen this number. The fear and greed index is absolutely screaming panic. Now you know the old saying, right? Be greedy when others are fearful. This is normally a massive contrarian buy signal. But the question is it really that simple this time around? And here's where the plot thickens. We look at the VIX, the market's so-called fear gauge, and yeah, it's elevated, it's around 19, it's nervous, but it is nowhere near true panic levels. So what gives? Why is one indicator freaking out while the other is just kind of worried?
It's what we can call the VIX/fear paradox. See, the fear is totally real, but it's a calculated, justified fear. It's showing up in people dumping riskier assets like junk bonds, which the fear and greed index picks up on. But it's not showing up as a mad dash to buy insurance on the S&P 500. This suggests it's a smart, calculated retreat from risk, not a headless chicken panic.
And from a pure chart watcher's perspective, this is probably the most important thing that happened last week. On Friday, the S&P 500 came down and tested its critical 50-day moving average. And the buyers showed up. They defended that level. For now, the line is held. The bulls are holding the fort.
Okay, so with all that evidence on the table, let's get to the million-dollar question, the one everybody's asking. How real is the danger of a full-blown crash? Let's weigh the arguments, pro and con. First up, for the pro-crash camp, is Exhibit A, valuation. The Shiller P ratio, which gives us that crucial long-term perspective, is sitting at a whopping 39.51. And let me tell you, historically speaking, that number is deep in the danger zone. Big time. And to put that number into perspective, just look at this. We are significantly higher than we were right before the Great Crash of 1929. In fact, the only time in history this reading was higher was at the absolute manic peak of the Dotcom Bubble in 2000. This is exactly the kind of data that has central banks so worried.
So, here it is, all laid out. It's a massive tug of war, isn't it? The bears have those explicit central bank warnings and extreme valuations on their side.
The bulls are pointing to the extreme fear signal as a reason to buy, and the fact that, so far, that key technical support line has held. The market is in this state of perfect, tense balance.
So what's the verdict? Here is the crucial point. This is not some unforeseen shock. We aren't just blindly running toward a crash. We are balancing, right now, on the knife's edge of the exact correction that the authorities have been warning us was coming. This isn't a surprise party. We were all sent an invitation.
So, with the market balanced on that knife's edge, every single eye is now glued to the week ahead. And it's shaping up to be not just a critical week, but a very, very unusual one.
What makes next week so unique is this macro data vacuum we're in. Because of the ongoing U.S. government shutdown, the most important inflation reports, CPI and PPI, they're probably not coming out. Think about that. The market is essentially going to be flying blind without its most important navigational tools from the U.S.
So when the U.S. goes dark, where does all the attention and all the money look for clues? Well, investors are going to be scrambling, looking at things like Germany's ZEW economic sentiment and China's industrial production data. But the real main event, that's going to be something else entirely.
The main event will be what I'm calling the week of the DAX. It's an absolute gauntlet of earnings reports from European heavyweights. We're talking Allianz, Siemens, Bayer, and Deutsche Telekom. With no U.S. inflation data to guide the markets, these old economy reports are going to be put under a global microscope.
And that brings us to the final, crucial takeaway question for the week. Will the results from these giants prove that what we're seeing is just a healthy rotation out of overvalued tech and into solid fundamental businesses? Or will their outlooks reveal something darker, signaling that this isn't just a correction but the start of a broader global recession? The answer will likely set the course for the rest of the year.